I'm on a mission to help entrepreneurs get the financial management skills that they need to grow their business. And today we're going to talk about the financial statements. We'll have a look at what they are, how you can read them, and more importantly, how you can get value out of them and use them in your business to make smart decisions to grow. Before we begin, if I could really quickly ask you to hit that subscribe button and then we can get going. So what are financial statements? Well, financial statements are reports that summarise the financial information of a business. They are prepared at the end of a period, which is usually a year, but some businesses also prepare them on a weekly or monthly basis too. And they are used by the management or the leadership of the business to make decisions on a day-to-day basis about the direction and actions that the business is going to take. And they can also be used by lenders and investors to make decisions about whether they invest in your business or lend you money in your business. There are three different types of financial statements: the income statement, or more commonly known as the profit and loss, the balance sheet, and the cash flow statement. We will have a look at each of these financial statements, and we'll also look at how they link together to give you or an investor or lender a full picture of your company's financial health. So let's start with looking at the balance sheet. So the balance sheet is broken down into three sections. We've got assets, liabilities, and equity. So assets are anything that your business owns or has the right to use. So for example, this could be machinery and equipment such as computers, and this is referred to as fixed assets. And other assets are cash that you hold in the bank, any stock that you have, and debtors, which refers to money owed to you by your customers. Next, we have liabilities, which refers to anything that you owe to other people. So this could be money owed to suppliers or taxes owed to the government, as well as longer term loans such as bank loans and mortgages. And the business also owes equity back to the shareholders, so this also comes under the liability section. And equity refers to any money that has been injected into the business by the owners, as well as any historical earnings that have been kept in the business and not taken yet as dividends. And the name balance sheet comes from the fact that this must balance. So assets always must equal liabilities and equity. So you can see that here these two numbers are the same. And if these two numbers aren't the same, the balance sheet just simply isn't accurate. There is no way that these numbers cannot be equal. And why is the balance sheet useful on a day-to-day basis? Well, you can calculate lots of various different ratios, which give you an indication particularly around the liquidity of a business, which is the ability for a business to pay its current debts. You can also see information such as stock levels, which will give you an indication of trends in the business and how well that business is being managed. And you can also tell a lot about the financial risk appetite of a business by using ratios such as the gearing ratio as an example, which will give you an indication of how much debt the business has. And this is very commonly used by banks when applying for loans and other financing products. Now, one thing to note about the limitation of a balance sheet is that it is just a snapshot in time. So the balance sheet today could look very different to the balance sheet tomorrow. So for example, if tomorrow I could go and take out a £10 million loan, and that would substantially change the numbers in the balance sheet. And therefore, I always recommend that when looking at the balance sheet, you look at several months or years worth so that you can see the trends and that you're not drawing conclusions on out-of-date information. Now let's have a look at the income statement, or more commonly known as the profit and loss statement. This shows us all of the income and expenses that a business has over a set period of time. And normally when we're looking at the income statement, we start at the top and we read from the top to the bottom. And at the top of the income statement, we can see the revenue, which is all of the sales that the business has made in this period. And then we have all of the expenses that the business has, such as cost of goods it's selling, as well as marketing, salaries, taxes, and interest, for example. And then right at the very bottom, we have the profit, or sometimes a loss, for that financial period. Now, most people have heard of the income statement or profit and loss or P&L and would be fairly comfortable with reading it and understanding how much money you've made. but it has much more value than that when used in a business on a regular basis. And that's because it gives you the most up-to-date information about how you are performing, and therefore you can use it to make smart decisions that will grow your business and lead to more profit. So for example, if you had just spent £2,000 on a brand new marketing campaign, and you can see by looking at your profit and loss that your sales have gone up, your gross margin has increased, and so has your profit, and you can pinpoint that these three positive outcomes are due to the marketing spend, then you can turn up that marketing spend and replicate that on a larger scale next month. Likewise, you may be in the opposite situation, and it may be that you need to turn down some of your costs in order to meet your profit goals, or even delay a project. So moving on to the cash flow statement now. The cash flow statement shows us how much cash or how much money has entered the business and left the business in a set period of time. Some people sometimes get confused with the profit and loss statement with this, but there are key differences, and that's because it only looks at cash. So for example, if you were looking at your monthly profit and loss, it could show that you'd made £5,000 of sales to a customer, but that customer hasn't actually paid you yet. So your income statement or profit and loss would show £5,000 of sales, but your cash flow statement would show zero cash in because your customer hasn't paid you yet. And there are also cash-only transactions such as loan repayments or dividends paid to shareholders that don't appear in the profit and loss. So the cash flow statement really is quite useful for understanding where all the business's cash is going. Now, the cash flow statement isn't as commonly used in smaller businesses because it's fair to say that their financial transactions tend to be much simpler and they tend to not have as many non-cash transactions. So if you're going to focus on learning the financial statements and understanding them, focus on the profit and loss and then the balance sheet. And then when you're really comfortable with them, come back and learn the cash flow statement. Because I tend to think that actually small businesses benefit more from looking at a cash flow forecast for the weeks and months ahead rather than looking at historically where their cash has come from. Let's do a quick recap of what we've looked at already. So we have looked at the balance sheet, which shows the assets and liabilities of a business. We've looked at the income statement, which shows us the revenue, expenses and profit or loss that a business has made in a set period. And we've looked at the cash flow statement, which shows the cash in and out of a business in a set period of time. Now, many small businesses fall into the trap of only preparing accounts once a year when they need to submit their tax returns. But my experience over nearly 20 years in finance has shown me that businesses that have strong financial management skills earn more profit and grow quicker. And a really key part of financial management is making sure that you have up-to-date information about how your business is performing at all times. And that means that you need to be preparing financial statements more regularly, at least monthly, sometimes even weekly. This means that you'll be able to make smart decisions that drive your business in the right direction. After all, it's no use knowing that you've made a loss this year. You need to know that you're on track to make a loss so that you can do something about it and turn around that ship. And as you are reviewing the financial statements on a regular basis, you will become much more comfortable with them and you will start to understand better how they link together. So as an example, you may decide to decrease your marketing expenses, and this in turn could have a knock-on impact and reduce your sales down by 20%. You'll be able to see this information about your profitability, your revenue and expenses in the income statement. But what you need to remember is that this will also have an impact on your cash flow in the weeks and months ahead. And this would also change some of the numbers in your balance sheet. For example, if you had bought lots of stock thinking that your sales were going to be at the normal level, you've now got higher stock levels than you normally had. So you've got cash flow tied up in there and your debtors number would decrease also. And this, for example, could impact whether or not a bank would approve you for a loan. So that one decision you made about reducing your marketing expenses has quite a knock-on impact further down the road. And that's why it's so important that you're able to interpret and understand what the financial statements are telling you, and that you can make smart decisions and that you fully understand the implications. Now, I could talk for literally hours about these financial statements. I am an accountant after all, and it is my passion. There is just so much more to tell you about the financial statements, which you will get so much value out of and be able to make much smarter and savvy decisions in your business to become more profitable, more cash flow rich, and to grow your business. So make sure you subscribe to my channel where you can find out lots of free information.